Hi everybody, I'm going to just do a quick analysis of our beloved stock market. I'm going to be using a calculator system called Truth Concepts to be able to do this. For more information on Truth Concepts, you can visit www.truthconcepts.com. Okay, so let's take a look at our market over the last, let's just say 30 years. So we'll go 1981 all the way up through 2010. Okay, and what we're going to do is we're going to take a look at the Dow Jones Industrial Average. So I'm going to go ahead and copy this and put it into a calculator that will show the actual yield behind this 30-year period of time. So what's important to note is that the first two decades, the 80s and the 90s, were just incredible years in the market. If you look at the full 30 years, there are only actually 1, 2, 3, 4, 5, 6, 7 losing years. So there are 23 winning years. If you look at the double-digit winning years, you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So 16 are double-digit returns. So if we were to add up all of these percentages and get to 2010 with 10.27, we would have an average yield of 9.73. So where does that number come from? Well, the number comes from adding all of these numbers up and dividing by 30. However, to really calculate the actual yield behind this overall investment, what we would have to, and let's say you just put it into an index fund and put it into the stock market, we obviously have to look at the negative numbers and the money that went into the market and earning literally nothing, actually losing money. So to best illustrate this, let's just look at a simple example of average versus actual yield. All right, so we're going to look at a four-year time frame. And we're going to say a person earns 100% on their investment in the first year, negative 50 in the second year, 100% in the third year, and negative 50% in the fourth year. So if you were to add all of these percentages up and divide by 4, you would have a 25% average rate of return. Now if you start to put money in every single year, let's say it's $5,000 a year, it would actually come out to be an actual yield of a negative 11%. So how does that work? So in the first year you put in $5,000 as your investment, you make 100% on it, and it doubles to $10,000. You start out the second year with 10, you add 5,000 to it, and then you lose 50%. So that's a $7,500 loss, and you start the third year with $7,500 plus an additional 5,000. So now you doubled your money again, wind up with 25,000. In year 4, you start with 25,000. You add another 5,000 and lose 50%. Now you have a negative 15% or a 50% loss and wind up with 15,000. So if you put in $20,000 cumulatively over 1, 2, 3, 4 years and wind up with $15,000, that's an actual yield of negative 11%. So take into consideration that the market has negative returns. Let's put in $5,000 a year and see what we wind up with. All right, we wind up with 7.96 instead of an average yield of 9.73. Okay, so let's do the math to ensure that this is accurate. So 5,000 in, you wind up with $607,200 at the end of 30 years. So let's go and look at just a simple future value calculator and type in $5,000, annual rate 7.96, years 30. Okay, you wind up with 607,034, and that's because this is probably 7.952162, multiple decimal points there. So yeah, so this is your actual yield. Okay, it's almost 2 points below what the average yield is. Now, putting money into the stock market is not something that's free. If you have a mutual fund or another type of managed account, you're going to have to pay some management fees associated with that. So let's say that your management fees are 1.5%. So that's win, lose, or draw. Every single year, typically what money managers will do is charge you a certain percentage of what they hold under management. So now what that does, it depletes the account to $434,000, okay, which is a relatively large loss, $170,000 or so. So now your actual yield goes to 6.2%. Now, if this is a non-qualified asset, you're going to have to pay some taxes associated with this. Some short-term capital gains, some long-term capital gains. So let's add in a mix and say it's 20%. So if you have 20% that you're paying on taxes on your gains during those years, now your actual yield goes down to 4.12%. Now, looking at why an individual keeps money in the market over an extended period of time is obviously to make up for some of the losses and corrections that occur, which is very understandable. However, looking at long-term investing, you have to take into consideration that our dollar is going to lose value. CPI is the Consumer Price Index, and looking at that calculation, it basically means that over time, the actual money that we have is going to lose value by 3.6% per year. There are other websites such as shadowstats.com. There are other indexes such as PPI, which is the Producer Price Index, that have different illustrations as well. But I think it's safe to say that we all agree that our money loses value over time. So 4.12 is your actual yield, and you wind up with $298,000 at the end of 30 years. But what is the value of that $298,000 after 30 years? So let's just take that question to the next 30 years. So over the next 30 years, if we look at 290, well, what's the final figure? Final figure, 298,114. So 298,114, let's say 3.6, which is the actual CPI right now, and we're in November 2011. So after 30 years, that amount of money is valued at $103,000. So it's lost about 2/3 of its value. So looking at long-term investing, looking at the stock market, it may seem like it's a viable tool, but if you really look behind the numbers and look into what actually gets eroded from your account, whether it's the management fees, taxes, or the hidden tax, which is inflation, it might not be all that it's cracked up to be. If we add in inflation here, 3.6%, your actual yield is 0.51%. So looking at the stock market having 23 of 30 winning years, 16 of which are double digits. Look at the mid-90s, for heaven's sakes. 34, 24, 23, 15, 23, but yet you wind up with an actual yield of 0.51. Hopefully this allows you to look at the stock market a little bit differently. That's all for today.